What if silver at $92 isn't expensive, but massively undervalued? In the next 15 minutes, you'll see the exact mathematical framework billionaire investor Eric Sprott is using to justify a $300 silver target. We break down the geological ratios, the 150-to-1 paper-silver leverage, exploding industrial demand, central bank gold accumulation, and the growing structural weakness of the dollar. No hype, no emotion, just numbers, history, and hard data. If you care about protecting your wealth in an era of rising debt and monetary instability, this analysis could completely change how you view silver today. What Sprott confirmed in a recent interview is not a prediction. It is not a hope. It is a calculation. A cold, verifiable, step-by-step mathematical argument rooted in geological reality, physical supply data, and centuries of monetary history. And when you understand the calculation, you will see clearly why $92 silver is not the top of this move. It is, by Sprott's own analysis, a 73% discount to the fundamental value of the metal as it stands today. Before we go any further, let me be transparent with you. This video is a financial and educational analysis of publicly available data and Eric Sprott's publicly stated positions. It is not personalized financial advice. Every investor's situation is different, and you should always do your own research and consult with a qualified financial professional before making any investment decision. What we are doing here is walking through the mathematics together so that you can make an informed judgment for yourself, which is exactly what serious investors do. To understand why Sprott is so confident in his $300 target, you first need to understand one foundational concept, and it has nothing to do with charts, trading algorithms, or Federal Reserve policy. It has to do with the Earth itself. For thousands of years, across every continent and every major mining civilization from ancient Rome to imperial China, the Earth has produced silver and gold in a relatively consistent ratio. For approximately every 1 ounce of gold pulled from the ground, the mining process yields roughly 8 ounces of silver alongside it. This is the geological ratio, an 8-to-1 relationship between silver and gold production that reflects the physical abundance of these metals in the Earth's crust. Now here's where something extraordinary comes into focus. Right now in 2026, the gold to silver price ratio, the ratio at which the market is actually trading these two metals, sits at 56-to-1. The Earth produces them at 8-to-1. The market is pricing them at 56-to-1. That is a 700% distortion from the geological baseline, and it represents one of the most extreme commodity market dislocations in modern financial history. Sprott's core thesis is that this distortion is not permanent. Distortions of this magnitude always correct. The only question serious investors are asking is not whether it corrects, but how fast and from what price level. Sprott is notably conservative in how he builds his price target, and that conservatism is actually what makes the argument more credible, not less. He is not calling for an immediate return to the 8-to-1 geological ratio. He understands that silver's massive and growing role in industrial manufacturing, particularly in solar energy, electric vehicles, and semiconductor production, means that industrial dynamics can support a price ratio somewhat wider than the pure geological baseline. So his target ratio is 15-to-1. That is still almost double the geological average, but it accounts for the modern complexity of silver's dual role as both a monetary asset and an industrial input. Now apply that 15-to-1 ratio to the current gold price. Gold has established what Sprott and many institutional analysts regard as a structural floor above $5,200 per ounce. This is not a speculative spike. Central banks around the world purchased over 1,400 tons of gold in 2025 alone, and in just the first 2 months of 2026, sovereign nations had already acquired 380 additional tons. These are not momentum traders. These are governments with trillion-dollar balance sheets making long-term strategic decisions to reduce their exposure to the dollar-based monetary system. That buying has permanently repriced gold. Take $5,200 and divide by 15. The result is $346.67 per ounce for silver. That is the fundamental value implied by Sprott's analysis. With silver trading at $92, the market is currently offering you that asset at roughly a 73% discount. That gap between 92s and 346 UX is the opportunity that Sprott is positioning his billions of dollars around. Understanding the price target is one thing. Understanding why the correction is now inevitable rather than merely possible requires us to look at the structural condition of the silver futures market, and what we find there is genuinely alarming. The COMEX futures exchange in New York has historically served as the primary price discovery mechanism for silver. It is where the spot price is set and where industrial buyers, investors, and speculators interact to establish what the market believes silver is worth. But the COMEX is not a physical market. It is a paper market, meaning that the vast majority of contracts traded there never result in the actual delivery of physical metal. Traditionally, only about 2% of futures contract holders ever stand for delivery. Everyone else rolls their positions forward or settles in cash. This system functioned relatively smoothly, as long as that 2% delivery rate held. But here is the critical structural problem that has been building for years and is now reaching a breaking point. The ratio of paper silver contracts traded on the COMEX to the actual registered physical silver sitting in the deliverable vaults, metal that can actually be handed over when someone demands it, has reached approximately 150 to 1. 150 paper claims for every single real ounce available for delivery. To appreciate how extreme this leverage is, consider that in 2008, the major investment banks involved in the mortgage-backed securities collapse were leveraged at roughly 30 to 1. That level of leverage was sufficient to bring down Lehman Brothers, nearly destroy Bear Stearns, and push the entire global financial system to the edge of collapse, a crisis that required trillions of dollars in emergency government intervention to stabilize. The silver paper market today is 5 times more leveraged than the banking system was at its most dangerous moment in 2008. And critically, delivery demands on the COMEX have increased by 400% over the last 18 months, as institutional investors, sovereign wealth funds, and family offices begin standing for physical delivery rather than rolling paper positions. Every ounce that leaves the registered vault category tightens the remaining leverage ratio further, accelerating the very dynamic that Sprott argues will ultimately force a violent price revaluation. What makes the 2026 silver setup structurally different from every previous precious metals bull market is that this time, monetary demand and industrial demand are both surging simultaneously, and the industrial side alone is already threatening to consume the entire global annual supply. In 1990, global silver demand totaled roughly 450 million ounces per year, with industrial applications accounting for about 30% of that figure. Photography was a major demand driver at the time, consuming enormous quantities of silver in film processing. When digital cameras disrupted and ultimately destroyed the photographic film industry in the early 2000s, many analysts predicted that silver demand would fall sharply. Instead, industrial demand accelerated to fill the gap and then surged far beyond it, growing from roughly 500 million ounces in 2010 to 650 million ounces by 2020, and now projected to exceed 900 million ounces in 2026. The primary engine of that growth is the global transition to green energy infrastructure, and the numbers involved are staggering. A utility-scale solar installation requires between 10 and 20 tons of silver per megawatt of generating capacity. The International Energy Agency projects that global solar capacity must increase by 4,000 gigawatts by 2030 to meet international climate commitments. That single infrastructure build-out implies a silver requirement that, when calculated against current annual mine production of approximately 850 million ounces, would consume the equivalent of the entire global annual supply. And that calculation does not include investment demand, jewelry demand, or the growing accumulation of silver as a monetary reserve asset by central banks in China, Russia, and India. The supply side offers no relief. Global silver mine output is not growing. It is actually declining, because the highest-grade primary silver deposits have been largely depleted. Most silver mined today comes as a byproduct of copper, lead, and zinc extraction, meaning that silver production is constrained by the demand for those industrial metals rather than by the price of silver itself. You cannot simply build more silver mines to solve a silver shortage the way you might scale up production of a manufactured good. The geology is fixed. There is one behavioral signal in this script that stands above all the charts and calculations as a real-world confirmation that the supply crisis is genuine and accelerating. The world's largest industrial consumers of silver, companies that collectively manufacture billions of smartphones, solar panels, and electric vehicle batteries every year, have stopped trusting the open market to supply their future needs. Instead of buying silver through normal commercial channels or hedging through COMEX futures contracts, companies operating at the scale of Samsung, Tesla, and Panasonic are reportedly approaching junior mining companies in Mexico, Peru, and Canada, and writing checks for $50 million, $100 million, and in some cases, $200 million in upfront cash. In exchange, they are securing exclusive rights to silver production that has not yet been mined, metal that will not be available for delivery for another 2 to 3 years. Think carefully about what that behavior reveals. These are some of the most sophisticated procurement operations in the world. They have entire departments dedicated to commodity risk management and supply chain optimization. When organizations of that sophistication are willing to pay large premiums today for metal they cannot receive for years, it communicates something unambiguous. They believe that waiting to buy silver through normal channels carries a risk of not being able to source it at any price. That is the behavioral signature of a genuine supply crisis, and it is happening right now beneath the surface of the official silver spot price. The final dimension of Sprott's thesis operates at the level of global monetary policy, and it is the context that ties everything else together into what he describes as a perfect storm for hard assets. The Federal Reserve currently faces a policy dilemma with no clean resolution. When it raised interest rates to 5.5% in 2023 to combat inflation, the stress on the banking system became visible almost immediately. Silicon Valley Bank, Signature Bank, and First Republic all failed within months, requiring the Fed to inject over $300 billion in emergency liquidity to prevent a wider systemic collapse. The fragility revealed by those failures has not been repaired. It has simply been papered over with a series of repo operations and currency swap arrangements that accomplish the same liquidity injection without appearing on the official balance sheet. Meanwhile, the bond market is sending a clear and uncomfortable message. The yield on the 10-year U.S. Treasury has risen from 3.4% at the start of 2026 to 4.9% today, even as the Fed has been signaling its desire to cut rates. When long-term rates rise while the central bank tries to ease, the bond market is expressing a loss of confidence in the institution's ability to control inflation. And when bond market confidence in a central bank deteriorates, the currency it issues historically begins to lose purchasing power at an accelerating rate. The numbers behind this vulnerability are not subtle. U.S. federal debt now stands at $36 trillion, compared to $370 billion in 1970. The Federal Reserve's balance sheet has expanded from $50 billion in 1970 to $7.2 trillion today. In 1970, the dollar retained at least a theoretical connection to gold through the Bretton Woods system. Today, it is a pure fiat currency with no commodity backing, supported only by institutional trust that is visibly eroding as BRICS nations actively construct alternative trade settlement systems designed to reduce global dependence on dollar-denominated transactions. Sprott draws an explicit parallel to the 1970s, when a comparable loss of monetary credibility sent silver from $150 per ounce in 1971 to $50 per ounce by January 1980, a gain of approximately 3,300% in 9 years. His argument is not that history will repeat precisely, but that the underlying macro conditions in 2026 are by every measurable metric more extreme than those that produced that historic move. And against that backdrop, the mathematical revaluation of silver to $300 per ounce is not a speculative scenario. It is, in his assessment, the destination that the forces already in motion are pointing toward. Here is what I want you to take away from everything we have walked through together today. Eric Sprott is not making an emotional argument. He is not trying to frighten you into a decision. He is presenting a series of interconnected, verifiable facts about geological production ratios, about COMEX leverage, about industrial demand trajectories, about central bank buying behavior, and about the structural condition of the dollar. And he is showing you how those facts, taken together, produce a mathematical conclusion about where silver's fundamental value lies. The gap between 92s and 346 is not noise. It is not a rounding error. It represents a 700% distortion from geological reality that has been artificially maintained by a paper derivatives market that is now, by Sprott's account, losing its grip on the physical supply chain. Whether that reversion to fundamental value takes 6 months or 3 years, the direction of the math is not in question for investors who understand what they are looking at. What you do with that information is entirely your own decision to make, informed by your own financial situation, your own risk tolerance, and your own research. But the starting point for any serious evaluation of silver right now is understanding the calculation that Sprott has laid out. And today, you understand it. Stay informed, stay grounded in the data, and whatever decisions you make them with your eyes open.